Welcome back to the channel, everybody. Today we'll be talking a lot about options. Got to talk about some of the stuff that I look at when I'm trading options. If you've been following me, you know I've raised my account from 50,000 to above 200,000 in just a couple of years. And in this video, I'm just going to be talking a lot about some key things I think everyone should know about. It's going to cover a little bit about a lot of different topics. And I'm going to talk about how to create a trade idea, how to choose price strikes and choosing your dates that you want to put these out to, using some metrics to help formulate these trade ideas, and then what you should do to secure profits and potentially manage trades. So a lot of stuff to cover in this video. It might go a little long, but I hope that anybody that watches this should take something away from it and hopefully make you a better trader overall. So you can know every option strategy out there, be the master of every option strategy that has ever existed, and you can still lose money because you can't come up with a trade idea. Options are useless unless you know how to trade stock and how to make up your own ideas. You can try to follow other traders, but the simple fact is you don't know what that position is for their portfolio. It could be a very small position. It could be acting as a hedge for another position they have on. And when you're trying to follow a trader's alerts, that kind of stuff, you're always going to be a little late. So they may enter the trade, and then you try to follow, and you get a worse fill, and then they may be out, and then you just don't see the message, or even if you do see the message already, the price could have moved a lot, and you lose again. So trading options, you really want to learn how to do it yourself. Following someone else's alerts is probably not the best idea, and the only way to learn yourself is to seek out that knowledge and continue to learn and practice. You can backtest also. So the first thing about options that you need to be able to do is figure out how to make up your own idea. And what I like to think of is basically you're trying to answer one of these questions or come up with a phrase that you fill in the blank. So I think a stock will stay above X price, and that would be something that might tell you to sell an option. This first group up here, I'll say, is when you're trying to sell an option, which is what I typically do, is I try to sell options. So if a stock will stay above X price, you might sell a put. You might sell a put's credit spread. You could buy a call debit spread if you like to buy a premium, or if you like to buy options. Similarly, if you come up with the idea that the stock will stay below Y, you'd be selling a call, or maybe selling a call spread so that you don't have a naked call. I've been trading options for a couple of years now, and I still don't like to have naked calls out. And I think that's more of an advanced strategy. Don't do it until you truly understand the risks involved and are comfortable with managing your positions. So if you're selling calls, either make them a covered call or a bear call spread. If you think the stock will stay between two prices, then you might do a strangle or an iron condor. And then if your trade idea ends up being one of the bottom three, that's where you might be looking more at buying premium. So if you think a stock will move a lot and it'll go above X price, then maybe you might buy an in-the-money call. Or if you really want to be a gambler, an at-the-money or an out-of-the-money call, although I hate to be on the other side of theta. And just basically what you're trying to do is come up with a plan. You should be able to say one of these phrases here, and that'll kind of lead you to what option play you should be doing. Now, the hard part is figuring out how to fill in one of the blanks in this sentence. And that's kind of what we're going to be talking about today. Go ahead and clear that out. So in order to figure that out, what I tend to do when I'm looking at options is I look at a couple of different indicators. One thing I like looking at is the RSI. That tends to be always on all my pictures here if you see it. And it's just kind of a little graph that shows when something that might be overbought or oversold. Those tend to be where the good entry points are when I'm putting on my options. And just kind of if you look at it, where this graph here is getting near the bottom here is typically where a bottom is on the chart itself. So when it dips really low, the stock tends to go up over time. And that's just an opportunity to sell a put because you're answering that question. I think a stock will stay above, that price, so I can sell a put and I'll end up winning on that. And you can look through, and that seems to happen quite a bit. So that would be about here, and you see after that it does go up. If it's way above that line, it might be overbought, so it might have a little pullback or consolidate. And again, you see it goes down. So that's just one thing I like to look at is RSI. It just kind of gives you a feeling of when it might be overbought, oversold. It can help you kind of time those entry points. Another thing that I like to see is like the implied volatility typically being higher than historical volatility. And that's what this graph in the bottom is showing you. For most things, we know that implied volatility is usually higher than historical or realized volatility. And that's basically what this graph just kind of confirms here. So anytime that you see that the blue line is above the pink line, that usually means that there was a more volatility that was expected. And so if you're selling premium, more than likely you probably collected out and came ahead because the realized volatility was a lot less than the implied volatility. You can see there are a couple times where that is wrong, but for the most part, this is why people like selling options, or at least why I like selling options. And a real reason why we can get those huge 95% win rates is because, quite frankly, realized volatility is usually less than implied volatility. Another thing I really like to do is look at support levels. And you can see that I have a couple bars on here that like show the green lines and red lines. I found a script that you can use on Thinkorswim to automatically plot those. And I made a video about that a while ago. So you can have it generate those. But another thing you could use is the volume profile study. And you can turn that on by going to studies and searching for volume profile. And what that's going to do is it's going to put up this blue stuff here. And basically what that's showing you is the price action of what happens when the stock reaches those price points. There tends to be a lot more volume. And when you're trading like 30 to 45 days out, that tends to be like what I like to call like my levels of support. Or like if I'm not able to watch my options, I know that if Apple in this case gets back down to 148, it might trade there sideways for a couple days, because I can see that there's a giant peak here in the volume. And if you go a little further down, the 130 range, so if Apple continued to fall and it gets to this area, it might take a couple days to get through that. And if you look further back to see where it's at that price level here, you can see there's a good chunk of time here. Where is that, like 2 months, where it's just kind of traded flat in that range. So like if it gets down there, there's time for it to pass and just kind of sit there. So when I'm looking to sell puts, I like to get below at least one peak, maybe 2 peaks. So in this case, like this would be a really nice peak to get under. So selling something, this would be like one of those things where I can fill in that sentence. I believe Apple will stay above 130 for the next 30 days. Because I know that if Apple falls down and gets to 130, like it tends to trade flat, and you can see like it took 2 months to get below that as a result of all that price action. So that's why I love using volume profile. It just kind of shows you where that price point might kind of hit like a wall and just kind of trade flat for a while it decides which direction it's going to do. The volume profile, think of it as like climbing a mountain. Like the bigger the peak is over here on the right, the longer it takes to get up there. And then if you're at the top of a mountain climbing back down, it's going to take some time to get down. Whereas if you're at like a small spot here, like it's not that hard to climb up like 1 foot and then go down 1 foot. So if the price gets down to this area, it can shoot down quickly to get to this peak. And so these smaller areas here, like it can blow through quicker. It's just something to kind of think about. So if 130 gets breached, then it could jump down very quickly to 81. Is kind of what I would see here if I was looking at the volume profile on Apple itself. Now, in this case, I was looking to do something on Apple. I tend to go bullish more often than bearish. So I'll be looking to sell like a put, and I'm using the on-demand feature so we get real prices when we like put on these trades. So the RSI indicator here is kind of neutral. I would like to be that a little bit lower than where it is now, but in the middle, that's fine. As long as we're sitting below good, a good level of support. And ideally, it looks like I'd want to be at about the 130 range, because if it gets there, it'll give me time to manage the position if I need to. And hopefully a sticking point, if it does go down, would be 148 in this instance. So I'd be looking to sell a put at 130 or at least below 148. 135 might be more conservative. And after I kind of like make that sentence up, that's when I'll start looking at what the premium would be. So what I was saying is I think Apple would stay above 130. So what am I going to be doing? I'll probably be selling a put, or I can sell a put spread. Those are probably the simplest strategies to run on this. Let's go ahead and take a look at what that would look like in this on-demand feature here. So I'm going to go to the Analyze tab. It's going to take a second to buffer. There we go. And I tend to sell options like a month out. Let that theta work its magic. And when you're selling options, like another thing that you do want to look at are some of the Greeks. And I'm not sure why it's not showing me my theta. I like seeing theta. Let me put that on here real quick. All right, oh, here it is, layout. Okay, so I'm going to customize this. I'm going to throw on theta. And that's only because I'm on the on-demand feature that it wasn't already on. So the two Greeks that I pay the most attention to is delta and theta. Theta will let you know how much money you're making per day that you've had this option sold. Or if you're buying the option, that's about how much you should lose per day if the stock stayed where it was. So if you're buying an option, time's running against you, and anything that's out of the money or anything that has extrinsic value left is racing to get down to the intrinsic value. And so if you bought this option, you see you should be losing $9 a day right now, and this is 31 days out. If we were looking at something that was expiring this week, you can see that number goes up significantly. So if you owned this option, you'd be losing $26 a day, theoretically. But if you sold this option, it'd be making you $26 a day. The other thing that you like to look at is the delta. That kind of also shows you the probability of being correct. So 44 delta here means it has a 44% chance of finishing out of the money, which means that you have a 56% chance of, a 56% chance of finishing out of the money or winning your trade if you're selling the put. If you're buying the put, 44% chance of this being in the money. So right there, less of a chance to win. But on top of that, because you're buying this, you have to have it move further in the money by about $5, because that's what you're paying for this option, in order to actually break even. And that's why, again, I love selling options. If you're going to buy options, I would suggest going deep in the money. It takes more money to buy that position, but your theta is significantly less. In this case, it's 3 times less. And there's less extrinsic value on the contract to begin with. You can see up here, this one has $500 that's going to burn over time. Whereas if you were to buy a 90 delta put on this play, you would only have $73 that can burn over time. So this $4 will go up over time, but the amount that you could lose total from extrinsic value burning away is 74, which would be made up by a $1 movement in your favor because you have 90 delta. Delta also tells you how much the option price is going to change depending on the stock. If the stock price moves $1 in your favor, so if you buy an at the money call or put here, and the stock went down $1, the option price will go up 44 cents, which means you made $44 if the stock moved down $1. Whereas if you bought a 90 delta put, a $1 movement, you should make $90. And typically, if you're at 90 delta, it tends to be $100 per dollar movement. Okay, so we just talked about delta, theta. When choosing the stuff, remember we said we were looking at 130 would be where our sweet spot. And in this case, we're looking, that's so far away from the money because Apple's trading at 174 in this instance. You'd only get $19, and by risking 13,000, to me, that's not worth it. So we go back to the chart here, and we also see that the other peak that we'd be fine going under, which I said before was 147, And we see that if it does get down here, it does take a while to get through that. So if we can see what the 148's worth, if it's worth like 1%, that might be what we would sell. So 145, a little bit less. Well, okay, so this is probably a bad example. I don't think there's enough premium to justify selling an option on this case, but we'll just go ahead and put one on anyway for this example. When I'm looking at options, I would also want to see like at least a 1% return over the course of a month. So a quick way to see that would be take this and multiply by 100, so just move the decimal over. And if this number is greater than that, that's where your 1% return would be. So to get a 1% return, we have to be at 160. And looking at here, there's just not much volume there, and I don't watch every day, so I wouldn't put this on in real life. But just to put an example here, we'll sell the 160. And the delta is actually 14, which isn't terrible. Or sorry, 18. So it's not terrible. Another thing I'd like to see is that my delta should not be higher than $30 when I'm selling a put. And 30 is just considered aggressive. A lot of people will say 5 to 10 delta, 15 delta, but 30 delta seems to be where like the most aggressive people are still comfortable with selling an option. And then the next thing I like to do is look at the risk profile. Shrink this up a little bit. I actually have to change this date real quick. There we go. And then in this instance, because we sold a put at the 160 strike, we see that we get max profit if it stays above that, which is what we wanted. And if it goes below 160, we're looking at buying 100 shares, unless we were to manage the position. And our break even would be lower, so we collected $1.66, so our break even would be about what is that, 158.34, 158.34ish, and you can see that that's where the break even is. All right, so that's what it looks like if you're going to sell a put. Now let's say instead of just selling a put, we felt that Apple was getting near peak and we were fine with doing some kind of bearish play on it. And basically what we're looking to answer is, what do we think Apple will stay below? If I was going back to the charts here, I guess Apple probably wouldn't be a good one here. What I would like to see is like a defined top from before, so that you can kind of say, oh, it's not going to go above that for sure. And I'd like to look at a longer time frame to get that, and just ignore that I just drew that. Let's go ahead and just go to like a different stock. I don't know, Tesla is always fun to look at, right? All right, so Tesla here, we have a pretty big high that's way away from where we are right now, but 140 bucks above. So we wanted to sell a call spread or something along those lines. I basically say I don't want to be below this point, so I want to be above 1243. Let's call it 1250. I go to add simulated trades here and clean this up. And I'm saying I don't think it'll get above 1250. Let's let this buffer out real quick. So now we're looking at the call side. We're going all the way to 1250 or above. And honestly, the delta here is 24. You'd make 2,500 bucks if you sold this call here. And actually, since the delta is so high, I think I might just go a lot safer, especially since it's Tesla. We can get way out of Dodge here and still make money. So even 10 delta on Tesla. So we were said 1250, where 1243 was the high. Well, let's get way out of there. It's not going to get above 1,400 or 1,410. So in this instance, let's just say we sell this one, it's 10 delta. So now what I'm saying, when I'm filling in that sentence before, is that I think the stock will stay below 1410. And the high for the 2-year was nowhere near that. So going back here, theta is at 62 because we're selling this call. We'll be making 62 bucks a day while this sits there and goes. What I would also do is buy protection by a call beyond it. I don't want to be naked 100 shares of Tesla. You could also set an order to buy 100 shares if it gets like up to the strike price as like your hedge, but that would take well, if it got up to 1,400, that's $141,000 to do, which is better than it blowing through and you losing a lot more. But the other thing you could do is go further out. Say I wanted to do 100 wide, that's a $10,000 risk because it's the difference between the spreads. And I just consider that buying insurance. It's okay. It does take away from the premium that you get overall. So instead of making $960, we make the difference between these, which is a little over $300. Maybe that's $350 or so. And if we look at the risk profile, we see that as long as Tesla stays below our strike price, we make $335 off the spread. If for some reason Tesla shoots up to 2,000 or beyond, we only lose the difference in the spread minus the premium that we collect. So in this instance, it looks like that was actually 90, right? Because it was 1,410. So about $9,000 minus the premium we got. So it's just defining your max loss so you don't end up owing more than you have in your account. And whatever you're comfortable with that protection being is what you would go with. Now, the reason why in this example I would go so far out is because I highly doubt Tesla would ever get up to 1,410 in a short 30 days time period. But you just never know. But in this case, I'm willing to risk $10,000 on this play in order to collect a little bit more premium. You can lower this to be a $5 wide spread. If we go back here to show you what that would look like, you would be buying the 20 here. And actually it shows it's a debit, but that's because the spreads here are so wide. If you use the midpoints, you would have a small credit, but you can see like you're getting a little bit of money, but that's because your probability of being, because you're so far away from the action. That's why the credit you're going to be getting for doing this play is wrong, or small. But as a result of doing that, your max risk would be $1,000 minus the premium that you get. If we go ahead and put in the midpoints here, you can see what it ends up being. So what would that be? Let's call that 980. Then that would be 9. So you make $80 risking $1,000 if you were to do a 10 wide spread. So it's just, you make less, but you also risk less. So make $80 off of that $1,000. And again, because we're so far away, like our probability of winning this would be 90% because the delta is 10 here. What else we're going to talk about in this video? I think we're going to talk about managing positions. So something that a lot of people will say is they will manage their positions at 21 days left of the contract. And that's when Vegas starts to kick in. Basically, price movements in the stock in the last 21 days greatly affects your options. So if it goes against you, you lose quicker, or you can win quicker as well. But people are just sitting there trying to collect theta. So at like 21 days left, they'll roll out the contract to like another 45 days because they're really just targeting winning that time decay and trying to stay delta neutral. I've had people that also will always put on a profit taker. So if they sell an option, such as this Tesla one for $980, if that ever gets down to 50% profit, I have a bid set up automatically to close it at 50% profit, and then they'll look at the option chains and put on their next position. So if Tesla went down for some reason, this would hit 50% profit early, and they would close it and take that one. Another thing is, people ask all the time when they should roll an option. First off, a lot of my options, like I tend to win like 95% or maybe even more than that on all my option plays, but a lot of those turn red at some point. Like, don't freak out. If your strike price is not being challenged at all, you have nothing to worry about. Like, your trade that you put on is still right. unless you receive like some kind of news or something has fundamentally changed your trading thesis, you don't need to fix a trade that you're already winning. An example might be that the market IV might be going up, so extra value is being injected into the option that you sold, which would increase the price, which shows you losses. But if the stock price is nowhere near your strike price, I wouldn't be worried. Eventually, theta is going to eat away at that. So be okay with holding through a little red, especially if you're out of the money. When you start to get in the money, that's when you might consider, do I need to change something up here? Now, I tend to wait until near expiration. I figure I like the higher theta decay to happen before I roll the option. Others will say you should roll when you're at the money because you do get a little higher credit if you roll out at that time. But when I was looking at some different options, it looks like the amount of the difference that you get for doing it at the money, regardless of how long out it is about 10% versus being deep in the money. So if I was to roll something for a $100 credit that was deep in the money, if I did it when I was at the money, I might have made an extra $10. So I don't think rolling just because it's at the money is the best thing to do. Or, I mean, I guess it is a little bit more efficient, but for that small percent of a percent, I don't think it's worth changing your entire strategy for. Roll if you think that you need more time to be right. But before you roll a position, like ask yourself, do I still believe in my original trade thesis? So right now, your option has gone against you. Do you just need more time to be right? If so, close it down, roll it out a month. And the reason why this works is because anything further out in time has more extrinsic value. So say we sold one of these, we're looking at a loss right now. We'll just say 10.55. We would buy this back for $84. We're taking midpoint here. And if we go further out in time, even just 2 weeks, and we look at it, we could sell it for $94. So we pick up an extra $100 for just rolling out 2 weeks. And this is why you take a small loss now, but that gets rolled into the next position. And if this one's right, you make back your loss from before, and you keep whatever credit you made when you did that roll. So that's what a very quick view of rolling an option would look like. And I guess another thing I want to talk about is just when you're putting on a trade, think about what could go wrong and what you would do when it goes wrong. I know that sounds kind of silly to do, but I just kind of assume that all my trades will go against me when I put them on. Luckily, they don't, but when they do, I have some sort of plan in my head about what I'm going to do when that happens. Now, a majority of the time for me, that's just I'm going to roll the position. If it's a stock I actually like and I sold a put on, which is what I would suggest, especially if you're just learning out or you're just starting out, only sell puts on stock you would actually love to own. So if you do get breached, the main outcome is that you bought a stock you would have bought anyway at a discount than when you would have bought it when you sold the option. That was kind of a mouthful. But if that's the worst outcome, then, I mean, that's a win for a majority of people. So my options would usually be I'm going to roll the contract until I'm right, or I'll just exit it if I realize that my trade thesis was wrong. It'll take a long time to get out, or I'll just take the stock and sell covered calls if I sold the put originally. So just something to think about is what would you do if the stock moves against you a little bit, a lot, or if it just wrecks you, what are you going to do? And part of that might be what makes you buy that insurance. So like when we talked about that call spread. Wow. I think this video might have gotten a little long. I hope I didn't ramble too much. If there's anything big that I missed that you think other people should know, go ahead and leave a comment below. Let me know. Let me know if you actually learned something or if you kind of like this format. I know I kind of talked a lot and went over a lot of different stuff in one video. And I hope that you guys have a good week and see you tomorrow.